Decentralized finance protocols advertise yields of 5, 10, 20, and sometimes hundreds of % annually. For traditional finance professionals accustomed to investment-grade bond yields of 4 to 5% in a post-zero rate world, these numbers are either extraordinary opportunities or extraordinary red flags. The analytically correct answer is, it depends entirely on what generates the yield. DeFi yields come from three fundamentally different sources: real economic activity, token subsidy programs, and outright unsustainable mechanics. Knowing which category a yield falls into is the entire analytical job. A 10% yield generated by borrower interest payments on a liquid, over-collateralized lending protocol is a very different risk profile from a 10% yield generated by inflationary token emissions from a protocol with declining user adoption. This video builds the institutional framework for distinguishing between these categories, and for determining what yield is actually achievable on a risk-adjusted basis in DeFi, net of the considerable risks that must be explicitly priced. DeFi yield derives from one of three fundamentally different sources, and correctly categorizing any specific yield opportunity is the foundation of institutional risk assessment. Category 1. Real economic yield. This is generated by genuine financial activity, borrowers paying interest on loans, traders paying fees for exchange services, or protocols generating revenue from users who extract real utility. Aave's lending protocol pays depositors interest funded entirely by over-collateralized borrowers paying higher rates. Uniswap's trading fee revenue is distributed to liquidity providers based on their proportional share of the liquidity pool. These yields exist because economic activity creates them. They are structurally analogous to interest income or dividend distributions in traditional finance, with the caveat that the underlying risk profile is considerably different from investment-grade instruments. Category 2. Token emission yield. Many protocols subsidize liquidity provision by distributing their native governance tokens as additional yield. This is a marketing and bootstrapping mechanism, paying users to use the product. The yield is technically real in the short term but is structurally inflationary. As more tokens are emitted and if demand does not grow commensurately, token value declines. Category 3. Subsidized or Ponzi yield. The most dangerous category. Yield funded not by economic activity but by investor capital, project treasury, or unsustainable monetary mechanics. Aave is the canonical example of economically sustainable DeFi yield. Understanding its mechanics builds the template for evaluating any DeFi lending protocol. A borrower on Aave deposits collateral, typically 150% or more of the intended loan value, in ETH, WBTC, or other approved assets. This over-collateralization is the foundational risk control, analogous to margin requirements in traditional securities lending. The Aave smart contract algorithmically matches depositors' supply with borrowers' demand and sets interest rates dynamically based on utilization. When a pool is 80% utilized, meaning 80% of deposited assets are currently borrowed, interest rates rise, incentivizing new deposits and discouraging additional borrowing, bringing utilization back toward equilibrium. Depositors receive A tokens, interest-bearing receipt tokens that automatically compound deposited balance. The liquidation engine is the critical safety mechanism. If a borrower's collateral value falls below the minimum ratio, the protocol automatically liquidates the position, using the proceeds to repay the depositor. This mechanism protects depositor principal without requiring any human intervention. The yield generated by this system, typically 3 to 8% on stablecoin deposits depending on market conditions, is entirely funded by borrower interest payments. It is as close to genuine economic yield as DeFi produces. A risk-adjusted comparison across yield sources clarifies where institutional attention is warranted. U.S. Treasury yields, the risk-free benchmark, set the floor. Investment-grade bonds add credit spread above the risk-free rate, with well-understood, regulated credit risk. Aave stablecoin lending yields of 3 to 8% carry smart contract risk, protocol risk, and oracle risk in addition to the interest rate risk present in traditional lending, but the economic source of the yield is genuine. Uniswap v3 liquidity provider yields from trading fees are also genuinely economic, but carry impermanent loss risk, the risk that providing liquidity to a trading pair results in a worse outcome than simply holding the underlying assets if their relative prices diverge significantly. Both of these DeFi yield sources can be defensible for institutions willing to dedicate the operational and risk management resources to monitor them continuously. Token emission farming yields are highly speculative and should be treated as venture capital exposure, not yield. The token being distributed may or may not retain value. Subsidized or Ponzi-adjacent yields should be excluded from any institutional framework entirely, regardless of the headline APY. Beyond the yield source classification, 3 DeFi-specific operational risks must be explicitly priced in any institutional framework. First, smart contract exploit risk. DeFi protocols are software, and software has bugs. Since 2020, over $5 billion has been lost to smart contract exploits across the DeFi ecosystem, including the Ronin Bridge at $625 million, Poly Network at $611 million, and dozens of smaller protocol exploits. Even protocols that have undergone multiple third-party audits remain vulnerable. The strongest available proxy for exploit resistance is operating history with sustained total value locked. A protocol that has held $500 million for 3 years with no successful exploit has demonstrated resilience through significant adversarial testing. Second, impermanent loss. Liquidity providers on automated market makers like Uniswap earn trading fees but are exposed to impermanent loss, the mathematical cost of providing liquidity when asset prices move. During high volatility periods, impermanent loss can significantly exceed trading fee income, producing a net negative outcome relative to simply holding the assets. Third, oracle manipulation and flash loan attacks. Price oracles, the data feeds that inform protocol collateral valuations, are attack surfaces. Sophisticated attackers have used flash loans to temporarily manipulate oracle prices, triggering artificial liquidations or exploiting miscalculated collateral ratios to drain protocol funds. The DeFi landscape by total value locked is concentrated in 3 primary categories, each with different yield quality characteristics. Lending protocols, primarily Aave and Compound, represent approximately 35% of DeFi TVL and are the primary source of genuine economic yield. Borrower interest payments are the yield source. Over-collateralization provides structural protection. Decentralized exchanges and AMMs, Uniswap, Curve, and their successors, represent 28% of TVL and generate trading fee revenue as the primary yield source. This is real economic yield but comes with impermanent loss as the primary institutional risk. Liquid staking protocols, Lido being the dominant example, represent 25% of TVL and generate Ethereum staking yield of approximately 3 to 4% annually. This is genuine network yield, derived from validator rewards for securing the Ethereum proof-of-stake consensus. Of the remaining protocol TVL, a significant portion offers yield that mixes token emission subsidies with genuine fees, creating a yield profile that is partially real and partially inflationary. Institutional investors should concentrate attention on the lending and liquid staking categories, where yield is most clearly tied to genuine economic activity, before considering the more complex risk profiles of AMM liquidity provision. 5 criteria for institutional DeFi yield assessment. 1. Identify the yield source first. Before evaluating any return figure, determine unambiguously whether it is generated by economic activity or token emission. Economic activity yield is analytically comparable to traditional financial instruments with additional operational risks. Token emission yield is speculative. 2. Restrict to established protocols. The minimum criteria for institutional consideration are 2 or more years of continuous operation at $500 million or more in TVL, multiple independent security audits, and no successful core protocol exploits. These criteria exclude the majority of DeFi protocols and concentrate analysis on the handful with genuine operating track records. 3. Size DeFi allocations within crypto as a small proportion, 5 to 15% of total crypto exposure, to manage smart contract exploit risk as a portfolio-level constraint. 4. Ethereum liquid staking via Lido is currently the most institutionally accessible DeFi yield. The 3 to 4% staking APY is genuine network yield. SDETH is highly liquid, there is no impermanent loss, and Lido has one of the longest operating histories in DeFi. 5. Treat any stablecoin yield above 8 to 10% as carrying material uncompensated risk. In the current rate environment, any yield that dramatically exceeds this level is almost certainly embedding risk that is not disclosed in the headline number. DeFi is one of the most complex and rapidly evolving areas of digital asset markets, and one of the most important for institutional investors to understand, even if they never directly participate. Crypto Mechanics breaks down these mechanics with the precision and rigor that professional investors require. Subscribe now for analysis that keeps pace with how fast this space moves.